Good morning. How is my fellow conference attendees? I think this is an exciting opportunity for us to discuss the impact of the pandemic, what the federal government attempted to do with the CARES Act, and how this is really a monumental change for us, especially in the accounting profession, when we start to look at how the changes that the CARES Act has provided will ultimately change the way we look at debt, debt forgiveness, idle assets, etc. So the conference presentation that I am providing, I am Professor Constance Crawford. I am the director of the Master of Science in Accounting program at Ramapo College of New Jersey. I'm also the chair of the accounting department, and I'm a professor of accounting. Of late, I've been teaching primarily on the graduate level, but I do teach a lot on the undergraduate level when opportunity allows. So I've always been very interested in making sure that when I teach a graduate level class, I am bringing today's world into my presentation. And clearly, starting in March of 2020, when the pandemic hit, there was an unbelievable change, not only in our personal day-to-day lives, but also in the lives of many, many businesses. For example, when you looked at airline industry, the cruise line industry, restaurants, hotels, there was just a plethora of types of industries that were basically stopped. They could no longer conduct business because they were prohibited having face-to-face meetings or their clients coming to their place of business. Restaurants, etc. The retail industry was reeling, commercial real estate. It just went on and on and on. And here we are, May 2021. I don't think any of us envisioned we would still be at this point, but we are. So what did the CARES Act do? And did it provide the stimulus, the assistance, the aid that so many corporations needed when this tragedy struck? So the impact of COVID-19 has been staggering on the entire US economic system. We know that Wall Street initially reacted with a resounding crash, and there was clearly a need for intervention by the federal government. So now that we're starting to come back, interestingly, the stock market did come back very quickly. There still are industries that are struggling, but the overall stock market is doing very well. I teach financial statement analysis. There's a part of me that's a bit concerned, but also there is no denying that the market, after its initial negative reaction, came roaring back and is doing very well. So the federal government, whenever there is a crisis, they have to find a way to stop and restore the faith in the strength of our economy. And as I said, industries like retail, airline, cruise line, hotels, commercial real estate is also, especially in large cities like Manhattan, have been having problems. And therefore, we do function in a capitalistic economy. Granted, there are a lot of social and guideline requirements as far as minimum wage, standards of living, working conditions, and so forth. The ability to generate a profit is really the underpinning of what our society from that economic viewpoint is all about. And yes, the federal government has always had a say. There has been a component of regulation and requirement many times even we could talk about incentives for behaviors. Once the pandemic hit, we had the need for really a third party, meaning Uncle Sam, the federal government, to jump in and help us. So Congress really had to act quickly, and they did, and they created the CARES Act. So where, when, how COVID started, it has been somewhat linked to certain geographic parts of the country, but that's neither here nor there at the moment because we're all still struggling. We clearly still see schools not back in session, colleges still doing their remote Zoom lectures, grammar schools with still stagnated classes or limited opportunities, again, especially in states like Manhattan. So we have been struggling as an economy to try to cope with the outcome of our pandemic. And we did see, for example, large, extremely renowned types of retail entities. When you think of a Neiman Marcus, that was going to be the flagship store of the Hudson Yards, declare bankruptcy. We saw stores like Lord & Taylor, Brooks Brothers. We had Hertz Rent-A-Car. We had some of the large foundational, companies that really are at the front and center of what we would call successful examples of our US economy for years. These weren't fledgling IPO startups. Fail. Now, were they most probably on the road to crisis prior to the pandemic? Yes. Did the pandemic cause the bankruptcy filings? That will be debatable and something that we will explore for the coming years. But the end result was when you have these large anchor stores that file bankruptcy, it does impact the perception of how healthy our economy is. And that is a very critical aspect of what the federal government needed to do. They needed to almost become the adult in the room and calm everyone down and let everyone know that they will be there, they will help businesses, they will provide unemployment, they will give stimulus checks, there will be answers. We will not be left without some financial support. And that is critical from the lens of an individual. It's also very critical when we look at it from the perspective of business. Now, unfortunately, what happened is as we had more and more of these bankruptcies, we also started to see the government step in, local, state, federal, and say, all right, landlords, you can't evict people, commercial also. We don't have to perhaps have defaults on lack of mortgage payments or student loans or car payments. And so really it was kind of a halt to what the normal contract said. I mean, if you're a landlord, you have commercial real estate and your tenants prior to the pandemic didn't pay you, you had the right of eviction. If you're a lender and the party that owes the money fails to meet their debt obligations, you have the right to foreclose. If you have a car loan, you have the right to repossess the property, and the list goes on. And all of that was kind of stopped because of the pandemic. Now, there is a bit of an interest on my part to determine whether or not once we return to whatever the definition of normal business will be in the future, whether or not contracts will now have clauses that are driven by the what if pandemic scenario, or what if the federal government comes in. Insurance has it. They look at crisis, pandemic, it's not covered. So it's kind of interesting how once you're faced with a situation that really wasn't on anyone's radar to the extent it occurred, how now that's going to morph and will change the way in which we do business. So it's very, very interesting to see how we have, airlines trying to come back, cruise lines, at least from the United States, still really limited, theaters, it was such a broad-based impact that we needed something. So the response was the CARES Act, the answer to corporate America's crisis. Well, we'll see. On March 27th, 2020, and that was fairly quickly, then President Trump signed into law the Coronavirus Aid, Relief, and Economic Security Act, known as the CARES Act. On March 18th, the president signed into law the Families First Coronavirus Response Act, which includes Emergency Paid Sick Leave Act and Emergency Family and Medical Leave Act. The legislation was intended to alleviate the strain of unemployment for the U.S. worker and provide much needed financial support for fledgling industries. The CARES Act included the following tax relief provisions aimed at assisting the crippling economic crisis. Number one, they reinstated net operating losses and other deductions. So what had happened, interestingly, is effective 1/1/2018, corporate tax rates were dropped to 21%. We pretty much changed a lot of the rules for what could or could not be used with our net operating losses prior to this legislation, which was in 2017, again, under President Trump's administration. Corporate America, loved it. Their taxes went from a high in the 30s down to 21%. There was no more minimum tax requirements. It just became a wonderful kind of, sense of release for for-profit corporations. But when the pandemic hit and the ability to generate a profit was something that was unheard of, the need to be able to go back and recapture prior taxes paid was really a very, very great source of liquidity for a lot of these fledgling companies. So the 2017 Tax Cuts and Jobs Act allowed taxpayers to once again carry back NOLs, net operating losses, and they could go back to 2013. Because starting in 2018, you could go back 17, 16, 15, 14, 13. So if you had payments and now you're having a loss, which for a lot of industries, 2020 will have that, they could recapture those pre-paid, if you will, or prior paid taxes. Additionally, the 2017 Tax Act limited the amount of net business loss a corporation could reduce. And again, they basically limited that and they postponed it. All right. So again, this way we wouldn't have to worry about, we can only, shelter 250,000 for individuals, 500,000 for married filing jointly. The CARES Act also allowed deduction for business interests to go from 30% to 50% of adjusted gross income for 2019 and 2020. So a lot of taxpayers amending their tax returns. There was a delay in when employers had to pay payroll and self-employment tax, which for, again, a significant payment for a lot of employees and employers. And essentially it allowed for it to be extended all the way through December 31st, 2022. So a lot of what the CARES Act did was try to provide sources of cash to companies that lacked revenue because they were unable to generate revenue because their businesses were told you can't operate. And so essentially 6.2% of payroll, or 12.4% if I'm self-employed, that would be for your Social Security and Medicare. Basically, they extended the payment. 50% of what you owed, you don't have to worry about paying until the end of this year, 2021, and the balance till the end of December 2022. So it's wonderful cash value for employees, employers. Employee retention, very important. The CARES Act includes an incentive for employers to retain employees during the pandemic. The Act provides for employers to receive an employee retention credit for qualified wages limited to $10,000 per employee. And remember, a tax credit is very valuable because it shelters dollar for dollar any taxes owed. A tax deduction shelters a percent of taxes based on whatever your tax rate is. The credit provides for 50% of such employers' qualified wages from March 13th, 2020 to December 31st, 2020. In addition, CARES Act provides similar tax credits to offset certain paid leave expenses. Depreciation of qualified improvement property, the CARES Act allowed you to write it all off, just take an immediate write-off. So again, limit the onus of paying a tax or provide an incentive if you had made a significant capital improvement. Charitable contributions were, again, amended the 10% limitation for corporate charitable contributions to 25%. And so then we started to critique it, and something that was very interesting is when a lot of these small businesses receive what were called the PPP loans, if they retained their employees, they did not use the monies to buy back stock or pay a dividend or increase the salary of a CEO. The government then announced, guess what? Those loans do not have to be paid back. We are going to classify them as grants, or grant means no obligation for payment or repayment. And they're also allowing that all of the monies that you used the grant for, wages, rent, just your normal operating expenses, would be deductible, even though the debt that was forgiven was not. So usually when you have debt forgiveness requires the inclusion of that forgiven amount similar to revenue. You've gotten the benefit. You owed $10,000. You now don't have to pay back that $10,000. So it's as if you received the money. But they, again, rescinded that rule. And it's the win-win in that not only do they not have to pay it back, assuming they fulfilled the qualifications of the debt conversion to a grant, they could also deduct on their tax returns all of the payments made for salary and rent and electricity and so forth. So again, the federal government is really actively attempting to make the societal issues and the causes of the pandemic's impact far less problematic. Now, Will this set a precedent? Will this mean that moving forward, if you have a struggling entity, should we punish them when debt is somehow renegotiated and forgiven, that they would now have to include it as revenue on their tax returns? Should we perhaps still allow, if these companies do not have to include this revenue on their tax returns, the deductions for monies used from that debt forgiveness? When you have the inability for a tenant to pay rent in a commercial environment, should we allow for that renegotiation? And it really is going to change so much moving forward, the perspective of how we look at business and what should be the impact when crisis hits. So it is a very, very interesting aspect. Also, we looked at the fact that we're going to send supplemental monies. We created a large amount of unemployment additional payments to make the loss of jobs less of an issue. Now, have we created a bit of a kinder, softer economic system for people in crisis? Today, I think we have. What the long-term impacts will be on the way in which people do business remains to be seen. So whether or not the CARES Act really is going to be the answer that we thought it was going to be remains to be a bit of a question. There have been some wonderful liquidity solutions. There have been some wonderful ways of looking at renegotiating the current crisis. But then we also have to ensure that we don't overregulate our business so that you almost take a bit of the incentive away to become profitable again. We're certainly right now in May of 2021 talking about raising corporate taxes from the current 21%, perhaps up to 25%. I don't really know where that's going to go. Perhaps to look at what might be deemed to be a wealth tax when you have segments of society that have extreme large amounts of wealth. Should there be some type of requirement? Another very interesting aspect is whether or not we should look at the income statement as a driver of tax revenue. Now, why is that interesting? It's interesting because, as I always teach my tax classes, the tax returns goal is to make the company seem as low in profit as possible. Why? Because the lower the profit, the lower the tax. The income statement wants to be a hooray for me moment. Let me look at and make my revenue as high as possible. Let me make my costs and expenses as low as possible so I look as profitable as possible. And then I'll accrue some taxes, but as long as I don't have to pay them on my tax return, I don't really care. And we refer to those as favorable tax differences when you're expensing a greater tax on your income statement than you're paying actually on your tax return. It's creating what we call an accrued tax liability. But now there has been discussion of looking at whatever the profit is on the income statement and assessing a 15% tax on that. Will that then motivate perhaps the corporate management teams to make their income statements look a little less positive? There also has been a lot of discussion about looking at a universal or a worldwide tax, so you don't have as many corporations fleeing and earning their monies in more friendly tax haven areas. So it really has put into the mainstream discussion of American business, the way in which we did business pre-COVID and the way in which we perhaps need to look at business after the pandemic. And maybe there have been large problems in the Internal Revenue Code, in the way in which taxes have been assessed, in the way in which businesses have reported certain transactions. But we also have to be careful, from my perspective, because you never want the tax code to be viewed as punitive. You always want it to be viewed as fair. I think for most people that are not tax experts, the Internal Revenue Code is literally something that seems a mass of words that make no sense. And that's because there are so many ifs, ands, buts, exceptions, provisions, penalties, and the list goes on and on. So it's interesting. I always read the Sunday New York Times, and I will tell you it has been the basis of most of my lectures in my classes, because pretty much every Sunday, whether it's in the real estate section, the business section, the editorial section, or the front page of Section A, there's something about taxes, COVID, pandemic, and how to fix it. Did the CARES Act fix it? No. Did it help? Definitely. Are there going to be more changes in the future? No doubt. But it's something that needs to be discussed. I think it needs to be discussed in a manner in which people can understand it. And first and foremost, make it something that appears equitable so that you'll have compliance and not companies trying to search for that that rainbow of a loophole that will allow companies to pay less taxes. So I hope you're enjoying the conference. I hope you enjoyed my presentation. And this is something that will remain and continue to be discussed in the future. And I guarantee you, I've got another article coming. This is Professor Crawford from Ramapo College of New Jersey. Lovely talking to you, and I'm looking forward to hearing your presentations as well. Bye-bye.